Hey, welcome back, everybody. It's Pete Carmasino again. And today, look, I'm going to be talking about a couple of sectors that are starting to break out. People are definitely looking, and I say people, institutional investors, investors alike, from retail level all the way up to hedge funds and everybody in between, are searching for areas, A, that look valuable to them, and B, maybe a little bit safer than the markets have recently sort of given us here as investors and market participants. What I mean by that is we've got volatility and value, as I showed you yesterday, a few days ago, is now outperforming growth. Again, in the near term, this can change, and you have to be very careful of this. There's a lot of things happening all at once, and we don't want to get too beholden to sort of a thematic setup and then all of a sudden switch it because we see different things going on. But you should have names and ideas and sectors on your watch list. And I'm going to give you a couple today to look at. There are actually three. The SPDR funds, Spider funds, the select Spider funds at State Street's series of funds. And it's going to be the banking ETF, that's KBE. It's going to be the regional banking ETF, symbol KRE. And it's going to be the insurance ETF, symbol KIE. So if you take a look at these three names, which I'm going to do right now, I'm going to look at these charts. I'll just show you what's happening, what I'm seeing, and maybe it's time to maybe open the hood up inside the ETF and see what's going on inside of there. Which names are performing, what names are setting up, what names inside of these funds look to be acting the best. You don't have to do that. You want to reduce single stock exposure, use the ETF. But they'll at least have three ideas here that you can take a look at, and maybe they're just starting to change trend, and maybe that's going to be the theme for 2026. Maybe financials in general will start to catch a bit more of a bid and get more activity in 2026. All right, let's look at the chart right now and see what's going on. All right, if you can follow my cursor, you see the crosshairs that are moving around. That's where I'm going to be talking about when I'm pointing to it. So right at this level, you can see back in August, this particular ratio, which is, again, the mega cap growth over value, rolled over, meaning that growth was started to underperform value. But that wasn't really the way to kind of completely flip your portfolio out of growth and into value. There was some opportunity there still in the growth phase. And obviously, this ratio moved higher up until just recently, the beginning of November, about a month or so ago. Now we're just seeing a sharper decline, or just as sharp as we saw before, right around the same level, ironically. I don't think that means much at all. I have the dollar up here, but it's not that significant. I can delete this and just look at this chart specifically to kind of just give you an idea of what I'm looking at. So again, we talked about this the other day. When you start to see this, I don't want to call it, it can be momentum. It's definitely growth, again, over value. Value kind of sits back, plays maybe a safer haven game. Doesn't mean it's not performing. It's just not performing as good as growth. And we know growth has been really the middle name of this market. So that's what's been going on in this index. Now, it just did put in a lower low. I don't really like that. A lot of people would look at this and kind of shrug their shoulders over it, which I don't blame them. But at the same time, maybe there's some opportunity here to grab, just maybe a safer haven in the next couple of weeks. Maybe there's going to be some volatility that might creep into markets that we may not expect. As I said, this week's pretty chock full of macro dense type information, CPI, retail sales. You got option expiration on Friday. So a lot going on. So let's dive into those three ETFs that I talked about earlier. I'll start with the State Street Spider Bank ETF. That's symbol KBE. All right, as usual, I've got the particular ETF right here, right? The one I'm looking at, that's KBE, the Spider S&P Bank ETF. Now, look, this just broke out of a nice range here. It just put in a 52-week high. I don't know if it's an all-time high, but I could scroll back and kind of look. It might be. But this particular name fund, I should say, has a lot of great, banking names in it, the usual suspects. The real interesting part about this is this lower panel. I'm just zooming in a little bit to get a look at just of roughly almost all of 2025. We saw just a downtrend, and now we're starting to see this bucking the trend. Again, volatility definitely helps folks rotate into potentially safer haven areas that might be considered value oriented, and that's okay. But that's what KBE is starting to look like to me. But definitely worth adding to your watch list. Not a recommendation. Remember, none of this is financial advice. It's just sort of what I'm seeing, what's happening on the relative strength radar, and that's kind of what I see in this particular name right now. All right, the next one here is the regional banking ETF, again, through State Street, and a very similar looking chart. So a lot of regional banks in this name. have been starting to look a little bit better. But these aren't your household names, so to speak, but they're local banks like East West Bancorp. More people might know that over Columbia Banking and all that. Now, this is an equal weight setup. Typically, some will migrate above the total equal weight level, which is about 2% or so, and some will migrate below. But that's what's happening here. This is, again, your smaller banks, whereas the previous one we looked at, KBE, is your larger banks. Your Bank United, Bank of California, Wells Fargo, Bank of America. Larger names. Citigroup is another one. In their Comerica is in KBE. KRE is just your smaller regional banks. Very similar setup. Really underperforming now for more than a year or so, and from the S&P standpoint, anyway. And just starting to peak its move, price wise, again, price discovery, just starting to peak above the 200-day moving average here on the ratio. Remember, down here's the ratio, up here is the ETF. So the KRE definitely breaking out and potentially looking like some opportunity here. Definitely added to a watch list. Okay, the last one here is another State Street ETF. It's KIE. That's the State Street Spider S&P Insurance ETF. You can see as obviously the underperformance really started back here in April, right around Liberation when the tariffs came out. Liberation Day, anyway. This has been underperforming the S&P. However, it's really been sideways, and I call this out all the time. When you're looking at it relative to the S&P, it's not been a great spot to be. The S&P would have done better, obviously much better than KIE. But at the same time, the longer term trend is intact. It's really just kind of sideways. You can call this range bound for sure. I don't think anybody's going to argue with me about that. But at the same time, we've got this opportunity, again, to add this to the watch list. Why? Well, we're in a sort of a dovish Fed situation, maybe a regime change. I don't know if that's going to happen sooner or later, but we're about to find out who the new Fed chair might be. And that's not until next year anyway. Yet we see this name here, KIE, does benefit from lower rates. And why? Well, insurance companies in general hold a bulk of their assets in bonds. Obviously, when rates get cut, bonds become a little bit more valuable, especially if they've got bonds that were yielding decent yields from 2022 and potentially they were non-callable, whatever their portfolios might hold. That just means that the value of the bonds could possibly increase a little bit. Now, is there safety in that? Do you get a piece of these bonds by buying the KIE? Absolutely not. But that's what's the underlying force, plus the fact that insurance companies in general, whether it's property and casualty, life, or a mix of everything that you can think of, property and casualty seems to me to be one of the better businesses. You're insuring something that might happen. Life insurance is something that will happen. You just don't know when. But all in all, that sector in general and financial services is looking pretty interesting. I think it's worth, again, adding to the watch list for those three names, potentially for 2026 and maybe even beyond. Let's see what happens here in the next couple of weeks. But those are the three charts that I like right now.